You are being trained to panic at the wrong time and stay calm at the wrong time. While you're watching stock tickers and arguing about whether a recession is official, the real crisis is quietly rebuilding itself in your rent, your paycheck, and your mortgage application. This is not financial advice. This is financial education. I want you to picture what happens when the foundations of the economy move under people who were told the foundations were permanent. In 2026, that moment is not theoretical. It is already here, and the scariest part is that it looks normal until it doesn't. Let's start with the story people won't tell you. A crisis can form quietly for months, sometimes years, and then it shows up everywhere at once. You see it in the headlines, yes, but you feel it first in your daily life. Groceries get harder, bills get higher, your savings stop growing, even when inflation cools on paper. And the moment you try to upgrade your life with something as basic as a home, the system stops pretending you matter. In the last decade, the public was sold a fantasy with a simple moral: keep investing, keep buying, keep leveraging. The rich borrowed cheaply and got richer while you were told to tighten your belt. Then the rules changed, and suddenly everyone who followed the rules found out they were playing a game designed for somebody else. You weren't stupid, you were just never given the full map. Here is what you are going to learn. First, why the current economic setup is more dangerous than the world got in 2008. Second, why real estate is not just down a little, but structurally cracking across residential and commercial. Third, why inflation damages the poor and middle class more even when it falls, and why your money losing purchasing power is not a temporary inconvenience. Fourth, what happens when cash dries up and debt becomes the choke point. And fifth, what you can do to protect yourself in a world where the window for safety is closing right now. The cold truth is this: the crisis you should fear is not a single crash, it's a chain reaction. First, let's talk about the market mood, because human behavior is the match and money is the gasoline. A few days before you notice anything serious, your brain already knows. You go into a store, you hear conversations that sound confident, you see people bragging about a deal, and you watch social media fill up with success stories that are one rent increase away from collapsing. This is not superstition, it is how speculative bubbles announce themselves. When people stop asking how they will survive bad outcomes, the bad outcomes arrive faster than anyone expects. During the run-up in housing and tech valuations, plenty of people were not investing. They were performing, they were borrowing and hoping, they were treating leverage like a shortcut instead of a risk multiplier. And for a while, leverage feels like competence. It feels like you're smart because your account is going up. Then the environment changes, and leverage stops being a strategy and starts being a trap. Back in 2008, the biggest warning signs were visible if you knew where to look: collapsing underwriting standards, mortgage terms that people didn't understand, and a financial system stuffed with complexity that hid basic failure. Today, the complexity is even worse. The instruments are more sophisticated and the leverage is deeper because the credit system learned how to hide risk inside layers of innovation. Now let's hit you with a number that should make your stomach tighten. Global debt is beyond $300 trillion. That is not a typo. It is so large that most people can't emotionally process it. And when you combine that debt with higher rates and shrinking liquidity, you get a situation where every borrower is squeezed at the same time. In 2008, there was a financial earthquake. In this cycle, it's closer to a slow-motion landslide where the ground keeps moving while people argue about what the weather will be next week. You want a specific bridge from then to now. In the years leading up to the last crisis, there was excessive risk-taking. But the scale today is different. The housing boom after 2020 in many Western markets pushed prices up faster than wages, and that created a hunger for financing. When credit becomes the oxygen, you don't need everyone to behave badly. You just need enough people to behave badly to keep the machine running until the machine can't breathe anymore. So what changed, and why does this feel scarier than 2008? One reason is size. The bubble is bigger. When you compare the scale of global leverage and the amount of debt outstanding across households, corporations, and governments, it dwarfs what existed before the last meltdown. In 2008, the market had not yet become so debt-dependent across so many layers. Today, the financial system is intertwined like a bundle of cables. Cut one cable, and you don't just lose one light, you lose power to everything. Another reason is structure. Leverage in 2008 was often blunt: mortgages, mortgage derivatives, and banks taking large exposures to housing-related risk. In 2026, leverage is more creative. It hides inside financing structures, private credit, subscription-like payment models, variable interest debt, and complicated refinancing schedules. The risk doesn't disappear, it migrates. And the third reason is linkage. The markets are more connected than ever. That means when the financial system tightens, it tightens everywhere. You do not get a clean, isolated failure, you get contagion. Nowhere is that more obvious than in commercial real estate, because it combines leverage, falling demand, and brutal financing costs. If you think commercial real estate is just an industry problem, you're wrong. It is a credit problem that travels through banks, private lenders, pension-like vehicles, and the financial plumbing that ordinary people rarely see. And right now, the plumbing is showing leaks. Here is what a real estate crash looks like when it starts. It does not begin with dramatic headlines. It begins with empty floors. Imagine a modern office building in a major city. You walk past it and it looks fine. The lobby is clean. The lights are on. A few tenants still pay rent. But then you go inside the data, the leasing reports, the vacancy listings, and you discover that the building is not full, it is just occupied in appearances. In 2026, vacancy rates in office markets in the United States and other Western economies are above 30% in many cases, and sometimes higher in secondary areas. That means that in a 100-floor building, around 30 floors are not producing rent, and when the rent stops, the loan payments don't. The loan terms don't care about your branding strategy. The debt is scheduled, the cash flow is not. You might wonder how this happened so fast. The answer is work itself changed. Remote work was not a temporary trend, it became a new default for many roles. After years of experimentation, companies learned that productivity didn't collapse. So they cut real estate costs the way they cut other expenses. Quietly, decisively, and without needing permission from the real estate marketing industry. A survey in the business world has shown that many companies have reduced office footprint materially. Some teams moved from leasing multiple floors to keeping a skeleton presence. Others reorganized office usage around collaboration days, not daily occupancy. Less office demand means fewer leases renewed. Fewer leases renewed means landlords either accept lower rent, offer incentives, or bleed vacancy. Now layer on leverage. When the economy was stable and rates were low, financing a building with high leverage could work. The math was forgiving. If interest rates rise, the math stops forgiving you. Let me describe a common scenario that has become painfully realistic. Picture a commercial office property that was financed with a massive loan. Assume 70% of the purchase came from debt. When borrowing costs rise, the annual interest expense can approach $500,000 for a single property, depending on size and structure. If the rent collected doesn't cover the interest and operating costs, you don't just earn less, you lose money every month, and you can't wait it out forever, because time is also an expense. Deferred maintenance turns into expensive repairs. Deferred debt turns into forced refinancing. And forced refinancing in a tighter credit environment is how manageable losses become permanent losses. Now here is where the story gets truly ugly. And it's not because office buildings are ugly, it's because the exit route is narrowing. When asset values fall, refinancing becomes harder. When refinancing becomes harder, lenders demand more favorable terms, or they refuse. When they refuse, sellers flood the market or properties go into distress. And distress spreads like a rumor that becomes fact. Once a respected landlord starts cutting prices to attract tenants, other owners feel pressure to do the same. The market reprices in waves. You might ask, why does that matter to you? Because commercial real estate debt doesn't sit in a separate universe. It lives inside financial products ordinary people touch indirectly. Retirement-linked investments, private credit funds, bank exposures, and insurance-linked balance sheets. So when commercial real estate starts cracking, it threatens the credit system that underwrites everything else. And that brings us to the next part, the part nobody wants to say out loud. The reason the crisis is worse than 2008 is not just housing. It is monetary tightening meeting an economy built on debt. In 1971, the global monetary system began shifting into the modern framework where fiat currency and debt expansion became the engine of economic growth. Whether you call it a revolution or a deterioration, the result is measurable. In recent decades, economic growth was increasingly supported by money creation and rising debt. Now look at what happens when the money creation stops. The Federal Reserve and other central banks have started tightening financial conditions. That means interest rates stay higher for longer, and liquidity is drained rather than replenished. Even if you don't study monetary policy, you feel it when credit becomes harder to access and more expensive to hold. This is where your purchasing power gets hit twice. Inflation may cool on a headline measure, but the damage is already done because the prices you pay for essentials don't always reverse. And the wages you negotiated didn't catch up. So your salary buys less than it did in 2019. In 2026, many people feel this as a psychological violation. You work, you pay, you budget, and still you don't move forward. You don't experience growth, you experience erosion. But here is the darker mechanics, the thing that turns a macro problem into a personal disaster. There are two types of inflation that matter for human survival: asset inflation and goods inflation. Asset inflation is when the values of financial assets rise. Stocks go up, real estate goes up. People who already own assets feel wealthy. That wealth can even make them spend more, which keeps the illusion alive. Goods inflation is when the prices of everyday necessities rise: food, energy, utilities, basic services. That reduces your purchasing power immediately. And it hits people with high debt the hardest, because debt is fixed while your costs rise. So while the rich are seeing portfolios inflate, you are seeing your bills inflate, and you might still have the same mortgage payment, or you might have refinanced at a higher rate, or you might be renting at a higher rate and saving less, which means you're compounding the problem by falling behind every month. Let's run a simplified example, because this is where abstract talk becomes real pain. Suppose you put money down on a home and you finance the rest with a mortgage. Your monthly payment is manageable at first. Then goods inflation keeps pushing up your costs. Groceries rise, utilities rise. Insurance rises, especially in regions facing climate-driven shocks. Suddenly, the household budget has less room. Then the central bank keeps rates higher. New credit costs rise. Even if your existing mortgage doesn't reset, the broader financial environment raises the cost of everything connected to credit: personal loans, auto financing, credit cards, business credit, and refinancing costs. Now, think about what happens to your tenants if you own rental property. Inflation doesn't politely stay inside your spreadsheet. Rent is a negotiation, and when households are squeezed, they reduce discretionary spending. Some tenants fall behind, some leave, some request relief. Landlords then choose between two bad options: reduce rent to keep tenants or keep rent and risk vacancy. Either way, leverage doesn't forgive, and now we have to connect this to the tightening of liquidity. When central banks drain liquidity, money becomes rarer. The same asset that was time worth it when money was cheap becomes less attractive. The same loan that was safe becomes risky. Not because your city suddenly got worse, but because the financing environment got worse. When you combine falling demand, high vacancy, high interest expense, and tighter credit, you create a debt problem with a housing address. Now let's add one more layer that you probably don't hear discussed enough: the withdrawal of foreign capital. In many Western real estate markets, foreign money played a role in high-end purchases, commercial development, and institutional financing. When global investors become risk-averse, they don't just stop buying new assets. They try to sell or restructure existing exposures. And when foreign capital retreats, the buyer pool shrinks. Even when you don't see it in your local newspaper, it shows up in pricing negotiations. It shows up in slower sales. It shows up in developers offering larger concessions. It shows up in the spread between asking prices and closing prices. And that spread is one of the clearest tells of a market losing confidence. In a healthy market, the asking price and the transaction price are close. People trust that deals will close quickly. When confidence breaks, sellers hold firm longer and buyers wait. That increases time on market. It also forces sellers to cut prices later, often more aggressively, because holding costs keep rising. If you want a concrete sign, watch the volume of transactions. When transaction volume falls while the number of listings rises, it means demand is evaporating faster than supply. That is when you stop saying it's a correction and start saying the market is repricing. And as you know, once the market starts repricing, it does it with speed because everyone is watching everyone else's price cuts. So what does this mean for residential buyers, especially the ones who were told to treat housing like a sure win? First, it means the old assumption is dead. The old assumption was that housing only goes up, and the only question is timing. That assumption created the behavior that built the bubble. If enough people believe prices always rise, they justify higher leverage. They justify buying with smaller down payments. They justify ignoring the monthly stress test because even if it drops, it will come back. The reason this fails is simple: liquidity matters. Asset prices do not only depend on inflation, they depend on what buyers can afford today and tomorrow. If credit tightens and wages lag, there is no buyer for an overvalued asset at the same price. Now, you might be thinking about your own situation. Maybe you're renting, maybe you already own, maybe you were planning to buy, maybe you just watched friends buy at the top. Or maybe you're one unexpected bill away from financial panic. So here is how you should interpret this moment. You are not watching a normal cycle anymore. You are watching a structural reset. Remote work and office vacancy represent one structural change. The other structural change is the insurance and climate risk problem. In many regions, insurance markets have tightened or collapsed under climate-related losses. When insurance becomes more expensive or unavailable, property carrying costs rise. That makes housing less affordable for buyers and less profitable for landlords. Then there is the retail and logistics disruption. E-commerce changed consumer behavior, and brick-and-mortar retail had to compete with cheaper convenience. In 2026, a wave of store closures is not a random shock. It is a signal that the traditional retail asset model is stressed, and commercial real estate is the container that holds all of these structural problems together. When the containers crack, the debt inside them becomes dangerous. Now let's bring in the scariest psychological trap of all. Social media sells the dream of passive income. It sells the idea that if you buy assets, cash will flow regardless of the economy. But most people who follow those videos are not buying assets. They are buying debt with a narrative. Most content about passive income ignores refinancing risk, tenant risk, vacancy risk, insurance risk, and interest rate risk. It also ignores the most important risk of all, that the market for your asset can freeze when you need to sell. And when markets freeze, you can't escape quickly. You can't negotiate your way out. You can't just wait for the next buyer if there is no buyer. So you end up trapped. Now remember the nurse I mentioned earlier. Let's actually use a micro story so you can feel how this works. Picture a 32-year-old nurse named David. He did everything right. He worked overtime during shortages. He saved. He paid his bills early. In 2021 and 2022, his goal became clear: buy a home so he could stop bleeding rent. He found a place, put down a decent amount, and got a mortgage with a payment he could manage. Then the costs kept rising. Not just his mortgage, but everything around it. His groceries went up, his utility bills jumped, the cost of maintaining a car jumped. The savings account he built for emergencies got consumed by reality. Then, when interest rates stayed elevated, David tried to refinance to lower his payment. The bank offered him a worse structure or denied the application because the appraisal didn't justify the same loan-to-value risk. He didn't do anything wrong. The math changed around him. And because he was not in a position to absorb shocks, David had a choice: cut healthcare needs, cut family needs, or cut the safety margin that prevents catastrophe. He didn't collapse in one day. He tightened for months. That's what people miss. A crisis is slow until it becomes irreversible. Now we will return to the question that matters most. What should people do? Before you decide anything, you need to understand your biggest risk. The biggest risk is not that prices go down. The biggest risk is that you are forced to act at the worst time because you are out of cash, or because your debt schedule forces you. That is why this next part matters more than opinions. If you own multiple properties with high leverage, you are exposed to a debt snowball. When rent declines or vacancy rises, your cash flow becomes insufficient. Then the bank wants you to refinance. But refinancing becomes harder in a tightening cycle. That is how paper gains turn into real losses. So the first move is risk control. Reduce leverage, protect cash flow, and preserve liquidity. In practice, that can mean selling non-core assets, especially those that do not generate a strong positive cash flow after interest and realistic expenses. It can mean refinancing into a more sustainable structure if possible. It can mean renegotiating with lenders where options exist. The details depend on your situation, but the principle is universal. Don't bet your survival on assumptions. For buyers who must buy for life reasons like a growing family or a real need to stabilize living costs, you still need patience. In this kind of market, the distance between asking prices and closing prices can widen. That means sellers eventually get pressured by time and carrying costs.